All right, now we will study IFRS 2 share-based payment, right? So, firstly, share-based payment became increasingly very common when an entity buys goods or services from other entities such as suppliers or employees and settle. What they used to do, they used to settle the payable amount by issuing a shares or share options. Settle the amount by issuing shares or share options, or incur liabilities for cash payments based on its share price. Liabilities for cash payments based on its share price, right? So what was the problem? Now let us look at the problem when before the introduction of IFRS 2. So the problem was, number one, if company pays a goods for cash for services in cash and expenses recognized in the profit or loss payment, but if a company pays for goods or services in share options, there is no cash flow and therefore under traditional accounting, no expense would be recognized, right? So um, it was if a company issues shares to employees, a transaction has occurred. The employees have provided a valuable service to the entity in exchange for the share options. It is inconsistent not to recognize this transaction in the financial statements. So to deal with this accounting anomaly, share-based payment requires transactions must be recorded in the financial statement when transactions takes place, right? So what were the problem? Number one, before the as I already discussed before the this standard came, what they used to do, they used to pay what they used to do before the standard came. Let me show you. They just show the transaction into the equity retain earning debit, share capital credit, right? And they do not use to recognize the expense. And obviously, when you will do this, what happens? They are not showing the actual expense occurred, due to which the shareholders of the company uh, was unaware that how much expense has occurred by providing the shares to the suppliers or employees, right? So when this standard came, what they used to, they said, now what you need to do when the share-based payments IFRS 2 came into being, they said, do this, recognize the expense, profit and loss account debit, and share capital credit. By this, now they has to show the expense which they were doing in exchange over share capital. So now the problem came into being. Uh, the companies, the organizations claims that why to recognize expense when there is no price. So standard claim, the IFRS claim that share capital actually has a price, and so you have to recognize it. Employees providing you services, they are providing you with services, they are incurring time on your work. It has a price, right? And another claim they made that EPS, earning per share, would hit twice. So again, standard said that it's actually two economic events. One, you are issuing the shares. Two, you are giving services to, you are taking the employee services or you are paying to the supplier. So obviously this will, due to this, your EPS will hit twice. Number third claim they made that it will have adverse economic consequences. So they said that if you won't show this expense, then it will have a further, a worse economic, adverse economic consequences, right? So these were the problems, and there are the IFRS standards based on this. Right now we have two type of share-based payments, two types of share-based transactions, right? Number one, we have equity settled share-based payment. Number two, we have cash settled share-based payment. Equity settled share-based payment. An equity settled share-based payment entity acquires goods or services in exchange for equity instruments of the entity. For example, shares or share options. Whereas in cash settled share-based payment, entity acquires goods or services in exchange of amount of cash measured by reference to entity share price, right? So now let us discuss each of these in more detail. Firstly, what we have, equity settled share-based payment. So when entity recognize goods or services as a result of an equity settled share based payment transactions, what they will post the following double entry. Uh, Profit and loss account debit, that means expense debit, and equity, or you'll say share capital credit, right? The entry to equity is normally reported in other components of equity, right? Share capital is not affected until the share based payment has vested. What is vested means, I will tell you in a while, right? So the basic principle overall here is that all transactions are measured at fair value, right? So in this case, let me tell you what you have to do in case of measurement. Firstly, consider that is the transaction is with employees or others providing similar services, right? So if your answer is yes, what you need to do, measure at fair value of equity instruments at grant date. And if the answer is no, then you have to consider that can the fair value of goods and services received be measured reliably? If the answer is yes, measure the fair value of goods and services received at the the date they received. And if the answer is no in this case, measure the fair value at grant date. Simple and easy. Now, what do you might be considering that what do you mean by grant date? The date at which the entity and another party agree to the agreement, whatever agreement they made, right? So some equity instruments vest immediately. In other words, the holder is unconditionally entitled to the instruments. In this case, the transaction should be accounted for in full on the grant date. However, when share options are granted to employees and there are normally some conditions attached to them, for example, service condition may exist that requires employees to complete a specified period of service. So in this case, IFRS 2 states that entity should account for services as they are rendered during the vesting period. Now, you might be wondering that what is mean by vesting period. So hold on, folks. Vesting period means it is a date on which the counterparty for example, employees becomes entitled to receive the cash or equity instruments under the arrangement. So the expense recognized at each reporting date should be based on the best estimate of the number of equity instruments expected to vest on the vesting date. The entity shall revise the estimate to equal the number of equity instruments that ultimately vest. Okay. Uh, so question is when to recognize transaction. So here it is. For example, here it is the year one, year two, and year three. Year one is actually the here you determine the fair value at grant date. And this period here, it is here you will calculate actual charge based on number that vest. And this period between the year one to year three, here it is the here you will charge the fair value over the vesting period based on options expected to vest. Right now, let us do one example before we move further. So here is the example. All right, so here is the example. An entity has a reporting date of 31st December. On 1st January 2000 it grants 100 share options to each of its 500 employees. Each grant is conditional upon the employee working for the entity until 31st December 2003. At the grant date, the fair value of each share option is $15. During 2000X1, 20 employees leave, and entity estimates that a total of 20% of the 500 employees will leave during the 3-year period. In 2000X2, during 2000X2, a further 20 employees leave, and the entity now estimates that only 15% of the original 500 employees will leave during the 3-year period. During 2000X3, a further 10 employees leave. Now we have to calculate the remuneration expense that will be recognized in each of the 3 years of share-based the payment scheme, right? So let us now do this example, solve this one. Um, let me do one thing for you folks. Where is my Excel? Yeah, here it is. And now, just in case we need to look the question further, although we won't need it, you not need it, but yeah. Okay. The total expense in this case recognized is based on the fair value of the share options granted at the grant date, that is 1st January 2000X1, right? So let me have it for you. The total expense recognized is based on the fair value of the share-based payment share-based options granted at grant date. Well, we are talking about in case of equity settled share based payment. Okay. The entity recognized the remuneration expense as the employee services are received during the 3-year vesting period, right? So now, firstly, what we will do, we will discuss about the year end, 31st December 2000X1. At 31st December 2000X1, entity must estimate the number of options expected to be vested by predicting how many employees will remain in employment until the vesting date. It believes 80% of the employees will stay for the full 3 years, and therefore calculates the expense based on this assumption, right? So what we will do is equal to some how many employees we had, 500 employees, and we assume that 80% will stay, so 80% bracket close. How many options we had? We had 100 options. And what was the fair value? The fair value at the grant date was 15, and we are taking out the expense of the first year out of 3 years, so 1 divided by 3. How much we will get? 200,000 in this case, right? So I hope you get how I get this. Now next, for the next year, then therefore the expense is recognized 200,000 for together with a corresponding increase in equity in this case. Okay, then now we will do the computation for the next year, that is year ended 31st December 2000X2. Okay, the estimate of the number of employees staying for the full 3 years is received at each year end, and on 31st December 2000X2, it is estimated that 85% of the employees will leave. sorry, 85% of the employees will stay for the full 3 years, right? As you can see, the example is in front of you still. Okay. And for full 3 years, the calculation for the share-based payment expenses, therefore, as follows. Is equal to sum. Here is equal to sum 500 multiplied by 0.85 bracket close multiplied by how many options we had 100. What was the fair value? At granted it was 15, and now, oh sorry, and now we are taking the expense of 2 years out of 3. So what we'll get 425,000. Okay, the previous let me do it over here again. Is equal to sum. How much was that employees? 500. Sorry, 500. Yes, and it was how many were retaining? 85% employees. What was the share options? 100. What was the fair value? 15. 2 years expense out of 3. 425. Right. Then less previously recognized expense. Expense. The previous year expense was, as we can see already, let us link is equal to minus because we have to deduct. It's 200,000. So is equal to this and this. Okay, sorry, is equal to sum this plus this. 225,000 is the expense for the year ended 31st December 2000 x2. Expense in year ended 31st December 2000 x2. Okay. In this case, equity will increase by 225,000 to 425,000. 425,000. How? Let me write it for you as well. Equity will increase by 225,000 to 425,000. How? Let me show you to you as well. 200,000 plus 225,000. Now we will do the final year calculation. What was that? Let us do it now. Now it's year ended 31st December 2000 x3. Okay. So in this case, as you can see, a total of how much? First 20 gone, in second year 20 gone, and now it's 10 employees gone. So total of 50 employees left, right, during vesting period. And the expense is recognized in the final year of the scheme will be as follows now. $500 minus 50 Okay, into 100 options into 15, and now you do not need to write 3 divided by 3. Okay, let me show you what I did. Is equal to sum 500 minus 50. We had 100 options, and the fair value was 15. So simply 675,000, right? Now, less previously recognized expense, less expense. What was that? Is equal to minus simply for the 2 years, 425,000 is equal to sum. This I'm adding because we already put it minus over here. So 250,000 is the expense for the third year. Expense in the year ended 31st December 2000 x3. Right. Now let me show you what will the financial statements will include. The financial statements will include the following amounts. Right. Firstly, state we will show. I'll show you about statement of profit or loss. Okay. 2000 x1, 2000 x2, 2000 x3. We will have staff cost in it. 200,000. 225,000, and finally 250,000. Then final year statement of financial position. Two thousand x1, 2000 x2, 2000 x3. Other components of equity. It's same 200,000, 425,000, and lastly 675,000. Right? I hope you get it till here, and that's all we need to do this transaction. I hope you get it. Now let us move to the further area after the example. Okay. Now what we have to look at, one of the thing is performance conditions. Performance conditions, and we have two types of performance conditions in case of share-based payments, right? In addition to service conditions, some share-based payment schemes have the performance condition that must be satisfied before they invest, such as specified increase in the entity's profit, the completion of the research process, project, or the increase in the entity's share price, right? So Performance conditions often classified into two categories. One is market conditions, and other is non-market performance conditions, or you can say not non-market conditions. So market condition is related to the market price. It is related to the market price of entity, equity instrument in the market, right? And such as the example of the market condition is an entity must have a minimum share by the vesting date for the scheme members to be eligible to participate in the share-based payment scheme, right? And market these are market price of the equity instruments are the volatile. So as per the IFRS 2, they can't be considered. We cannot they can't be considered. We cannot uh, you know consider it while uh, calculating the share based payments, etc., for the employees, right? So we cannot consider them. Now, non-market conditions are not related to market price of the equity instruments. And what are the example or is EPS, profit targets, right? These are profit targets, right? And they has control on it, so it can be considered, right? Whereas we will not look at the market conditions, but we won't consider market conditions, only considers non-market conditions. Remember it, right? Now, again, we will look at the another example. Right now, we have another example. On 1st January 2000 X1, 100 employees were given 50 share options each. These will vest if the employees still work for the entity on 31st December 2000 X2. Okay. And if the share price on that date is more than $5, see, and if the share price on that date is more than $5, it's saying on 1st January 2000 X1, the fair value of the option was $1. The share price on 31st December 2000 X1 was $3, and it was considered unlikely that the share price would rise to $5 by 31st December 2000 X2. The employees left during the year ended 2000 X1, and further 10 are expected to leave in following year. Now, the requirement is show above transactions or above how should above transaction be accounted for in the year ended 31st December X1. Okay, so I already explained you that firstly the expense recognized in is based on the fair value of the options at the grant date. This should be spread over the vesting period, and there are two types of conditions attached to share-based payment in this question. Number one, a service condition. Employee must complete a minimum service period, and yeah, this will be considered. This part, as you can see, which I'm highlighting with the green, will be considered, right? Whereas the above part, which now I'm highlighting with the pink, I already told you that it is a market-based condition and it's volatile. It cannot be considered. Another reason, one more condition that it cannot be considered, as you can see that although it is unlikely that the share price target will hit, this condition, number one, it is volatile, as I said, and number two, it already factored into the fair value of the options at the granted. So you need to ignore this condition. Okay. Now, uh, again, what I'm doing, I'm not turning on the split screen. Okay, we have to do this for only 1 year now. So what we will do simply is equal to how many employees we had, 100. In first year, 10 left, and then 10 left. How many options we had? 50. What was the fair value? 1. We have to compute it for 1 year out of 2 years. So how much we will get? 2000. And entry to recognize this will be profit or loss, debit 2000, equity, or you can say share capital, credit 2000. That's it for this part of the question. I hope you get it right. Let's move on to the next part. And again, we have one more example. Okay, we have one more example to be done. Right now, let us look at the example again, and here it is. On 1st January 2004, ABC granted share options to each of its 200 employees, subject to a 3-year vesting period, provided that the value of sales increased by minimum of 5% per annum throughout the vesting period. A maximum of 300 share options per employee will vest, dependent upon the increase in volume of sales throughout each year of the vesting period as follows. Number one, if the volume of sales increased by an average of between 5% and 10% per year, each eligible employee will receive 100 share options. If the volume of sales increased by an average of between 10% and 15% per year, each of eligible employee will receive 200 share options. Number three, if the volume of the sales increased by an average of over 15 per year, each eligible employee will receive 300 share options. At the granted, the Blueberry estimated that the fair value of the each option was 10, and that the increase in volume of sales each year would be between 10% and 15%. It was also estimated that a total of 22% of employees would have to would leave prior to year end of the vesting period at each reporting date within the vesting period. The situation was as follows, as you can see. Uh, Now, reporting period 31st December 2004, employees leave in year 8. Further employees expected to leave in the coming years 18. Annual increase in sales volume is 14%. Expected sales volume increase over the remaining vesting period 14%. Average annual leaves in sales volume to date is 14%. On 31st December Act 5, employees leaves in the year 6. Further leaves expected 4. Annual increase in sales volume is 18%. Expected sales volume increase over remaining vesting period is 16%. And average annual increase in sales volume to date is 16%. Okay, and then 31st December 2003, employees leaves is 2%, annual increase in sales volume is 16%, and average annual increase in sales volume to date is 16% again. And it's saying calculate the impact of the above share-based payment scheme on ABC financial statement in each reporting period. So again, let me open my sheet, and here it is. Firstly, what I will do, as you can see, yeah, over here, let me tell you, number one, at 31st December 2004, total of 24 employees, sorry, 26 employees, 8 plus 18 are expected to leave, expected to leave by vesting date, right? That means further 174 are expected to remain, and ABC estimates that the average annual growth in sales volume will be 14%, as you can see. Okay, consequently, it is estimated that eligible employees would each receive 200 share options at the vesting date. In year two, at 31st December 2005, total 18, how? 8 in first year, then 6, and then 4 are expected to leave. Okay, and that means 182 will remain expected to remain by the vesting period, and the sales volume is expected to increase by 16%. Consequently, it is estimated for eligible employees will each receive 300 share options at the vesting date. And finally, in year three, at 31st December 2006, now it is known 8 plus 6 plus 2, 16 have left during the vesting period. Eligible employees are now 184. As an average, growth in sales volume over the period was 16%. So eligible employees are eligible employees are entitled to 300 share options each. Okay, 300 share options, I mean. Yeah, 300 share options each, I mean. And then now what to do? Let us just do the calculation over here. And now what I will do, I will have the just a second. Yeah. Now I will have the heading, the reporting date. Next heading, calculation of equity. Then next heading, equity. Then next heading is expense, right? So first heading 31st December X4 reporting day. Calculation of equity. Let me show you. It's 174 as I mentioned in the first note into 200 options, and the fair value was 10, and it's for the first year over the 3 years. Now for equity, let me do it, is equal to sum uh, is equal to sum 174 multiply by 200 options multiply by 10 is the fair value at grant date, multiply by 1 year, for 1 year over the 3 years, what we will get 116,000, right? 116,000 is the expense as well. So what I will do, simply connect it. Then next year, 31st December X5, 182 multiply by, oh, yeah, multiply by now 300 options, multiply by the fair value at grant date, and it is for 2 years out of 3. So simply first calculate the equity. It's is equal to some 182 multiply by 300 multiply by 10 is the fair value into 2 divided by 3, 364, right? So 364 is equal to 364 minus 116. 248,000 is the expense for the year 2. Now let us move to the next year, 31st December X6. What will be the equity, calculation of equity for this one? 184 multiplied by, oh sorry, 300 options multiplied by 10 is the fair value, and just to show, although it is of no use, 3 divided by 3 now is equal to sum 184 multiplied by 300 multiplied by 10, that's it, 552, right? So 552 minus the expense last minus the expense of last 2 years, that is 248,000, and sorry, okay, just a second, is equal to expense 552,000 minus 364 actually. Yes, because it is the expense of last 2 years. We will get 188,000 for the year 3 expense, and that's it. That's how you need to do it. I hope you got it. If you have any questions, you can ask. And we are ending our this session till here. In next video, we'll continue with the remaining part of IFRS 2. Till then, take care, have fun, bye bye.